DeepSeek Saga brutally exposes the irrational exuberance of the AI trade. Budget 2025 should turbocharge consumer spending, and FedEx finally answers my prayers. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Couple of days late, guys, for this week's episode, and that's because I've got some major news to share with you. I am no longer associated, I'm no longer working with Brunel University. I decided to leave Brunel University, my previous employer, for to pursue a new career, new adventure in the investment sector. But before I begin, I just want to extend my gratitude and my thanks to all my lovely, wonderful colleagues and mentors at Brunel University. I mean, thank you so much for for these incredible 5+ years. Enjoyed every minute of it, and you I've learned so much from you guys. So if you are listening to the show, I just want to extend a very, very a sincere thank you from the bottom of my heart, and thank you for being a part of my life. And I really hope our paths cross again. Right. So new location from now on. Don't have my office anymore. I will be continuing to be an affiliate of the Brunel Business School as I can pursue my research projects on the side. However, given the fact I don't have an office, it's a brand new location for the Stock Doctor. Right. Where do we begin for this week? So that's why. And also just to let you know, this is why this episode is a couple of days late. I had a few farewell functions to attend as well. So clearly, 48 hours late than usual. But it's an outlier. We'll be back on Sunday again. So I mean, we'll be back to our usual time from next week onwards. So this is just a one-off thing. But then again, it's not every day that you leave the place that you have enjoyed working after 5 incredible years. So a bit of change there. Right. Before I get too emotional again, and it's not about, I'm not going to talk about, this show is not about me and my work and so on and so forth. This is about the investment industry. This is about the US markets. This is about Indian markets. So let's get this show started. Before though, I have to ask you a question. How many of you sold? And that's a very serious question, guys. I'm not messing about. How many of you sold your entire Mag 7 holdings, especially Nvidia, last week? And if you did sell it, did you sell it because of DeepSeek? And if yes, again, if your answer is yes, please turn off the show. And I'm just telling you, I'm just telling you know, I'm telling you right now, this show is not for you. If you sold it because of some random news about DeepSeek, you read, sold off all your holdings of Nvidia and the other Mag 7, bye-bye. This is not for you. Okay, I'd rather you lose listeners than having people who panic for no reason to be a part of the Stock Doctor family. That's not what this show is all about. It's about long-term focus. It's about long-term thinking. So, if you managed your risks and trimmed your holdings and rotated into other sectors during this DeepSeek saga, then absolutely fine. But if you just sold your entire position because of a couple of articles you read about DeepSeek AI without knowing what the whole story was about, then clearly, I repeat, the show is simply not for you. So I'm just putting it out there because I am going to, I'm gonna talk about DeepSeek. I'm gonna dissect the DeepSeek saga. I'm gonna do a deep dive analysis of it, and more importantly, I'm gonna tell you exactly. This is spoiler alert. I'm gonna tell you exactly why there's absolutely no need for any panic whatsoever. Now, before I go into DeepSeek and its impact and subsequent madness that took place in the week gone by, it's time to first take stock of the market action. Once the dust had settled, the DeepSeek-driven madness led to the S&P 500 slumping 1%, tech-heavy Nasdaq slumping 1.6%. The Dow, on the other hand, was a beneficiary of the madness as smart investors decided to use this opportunity to rotate into sectors other than tech. They already saw tech was, they already saw tech was slumping. Took this opportunity to trim their positions, rotated into the other sectors that have been badly, beaten up as a result of the AI-driven trade. And as such, the Dow actually finished the week marginally positive, gaining 0.3% to be exactly precise. So just goes to show that there were smart investors out there who decided to use this opportunity to go get into sectors that they've not been before, to rotate, to diversify in order to to maximize this situation, to rotate into sectors that were pretty much beaten up as a result of the entire money inflow into the AI trade. Now, I was supposed to talk to you guys this week about the first Fed meeting of 2025 and the mega earnings from Mag 7 constituents. Of course, I'll talk to you about the Mag 7 constituents, the earnings of Microsoft and Meta, but the Fed will have to wait until next week because the week, I mean, it was. I mean, it's just I don't know how else to put it. It's like Powell and Co can't catch a break. First, it was Trump, DJT, President Trump, the election victory and the potential tariff and all of that overshadowing Fed's last meeting in December. Now you have DeepSeek Saga completely confounding the Fed and messing up the calculations and putting them on the putting them basically pushing them towards the background essentially. So I will be talking to you guys about the Fed, about what the Fed did. I will combine that along with whatever we're seeing right now as we speak regarding President Trump's tariff plans for China, Mexico, and Canada. Along with that, so I'll combine the two because those two are related to a great extent, and I'll talk about it in the next episode. But this week's it's all about DeepSeek. So without further ado, guys, let me just welcome you to the first segment, Doctor's Weekly Snapshot, where I am going to, as mentioned earlier, I am going to go into the DeepSeek saga into much, much, much more detail. But before I go into what transpired in the markets, let me just give you a little bit of background about what DeepSeek AI is all about and why, before going into why it caused so much turmoil, especially to one stock, which is Nvidia. Okay. Now, first things first. What you need to understand is DeepSeek, not DeepSeek. DeepSeek is a Chinese AI startup. It's born out of a quantitative hedge fund. Okay, the company was founded by Liang Wenfeng, a math enthusiast who previously co-founded Highflyer, one of China's largest quant hedge funds, managing $8 billion. DeepSeek evolved from this hedge fund's use of AI for financial trading. So Liang Wenfeng was a math genius, is a math genius, and he basically, at the start, he used to build AI algorithms to trade, and essentially DeepSeek AI was born out of this. Now, why was it responsible for wrecking the Mag 7 stocks, especially Nvidia? Last Monday, it was a $1 trillion bloodbath on Wall Street, specifically the Mag 7 constituents. So the automatic question is, why was DeepSeek, a Chinese AI startup, responsible for a bloodbath on Wall Street? Well, it's clearly very simple. DeepSeek AI recently launched its R1 model, which supposedly, and for those listening, I'm using the air quotes, rivals top AI systems like OpenAI's reasoning models, but at a fraction of the cost. And the exact cost, according to DeepSeek AI's management, $5.6 million, which is a fraction of the billions and billions of dollars that are being spent by the American AI giants like OpenAI, Microsoft, and the hyperscalers like Microsoft, Google, Alphabet, and Amazon. The company claims to have achieved this by using less advanced chips and innovative trading techniques, bypassing the need for expensive cutting-edge hardware. By the way, they still used NVIDIA's chips, okay, which again confounds the 17% drop we saw in the stock and the subsequent, falling off a cliff that NVIDIA is currently experiencing. They still used NVIDIA's chips. It's just the fact that they used NVIDIA's lesser advanced chips, so to speak. They believe they use the I believe they use the H100 chips, which was remember, the U.S. government has put export control curbs on NVIDIA. They cannot export their advanced chips to China. And so, as such, DeepSeek continued to use NVIDIA's chips, but they use the lesser advanced. And this is why apparently they claim, again, I'm using air quotes for those who are listening, to have used, to have built these models at a fraction of the cost that the American counterparts were using. If this is true, and I repeat the emphasis on the word if, okay, because there's still a lot to be known about DeepSeek and its claims. If this would be true, if these claims are true, this would imply that the dominance of the likes of NVIDIA is seriously under threat, because NVIDIA's advanced chips, like I said, have been central to the AI boom. And it's simply NVIDIA. I keep mentioning NVIDIA because NVIDIA would be directly under threat, because DeepSeek's success, again using air quotes, would imply whether expensive infrastructure is necessary at all. NVIDIA, ever since DeepSeek Saga, has fallen off a cliff, like I mentioned, with its stock down nearly 20% ever since, and it was single-handedly responsible. Of the 20%, it single-handedly dropped 17% on Monday when Wall Street was going through a $1 trillion bloodbath. I mean, this thing has been absolutely wrecked. What's worse is that since the DeepSeek cat has been out of the bag, the Trump administration is exploring whether to put more export controls on Nvidia's chips to China, as clearly the current restrictions have been less effective than intended. Well, no surprises there. Okay, so you have an efficient AI model from China that was allegedly created at a fraction of the cost. Does that automatically mean we sell everything and go away? Clearly not, which is why I call Mondays and subsequent last week's, the entire week's market action, an insane overreaction. One that was not just overdone, but leaves me questioning just how much irrational exuberance there was in the AI trade. But you know what? In a world where there are investment products that are hypercharged on leverage, you had leveraged ETFs, single stock ETFs on Nvidia and Tesla and all of that. This shouldn't necessarily come as a surprise, as any sell off on bad news tends to get out of hand real fast as investors unwind their leverage driven trade. And that's exactly what really transpired here, ladies and gentlemen. It is just too many financial products that are hopped up on leverage that on these stocks, on these names such as Nvidia and Tesla, really wrecked the trade, wrecked this, that really accentuated the sell off even more. But before you, and simply, when you have these crazy products like leverage ETFs getting unwound because of the sell-off, clearly long-term investors like you and I, the ones who are, you and I mean, this is under the assumption that the ones, all of you guys who listen to the show are long-term investors like me. So long-term investors like you and I clearly are collateral damage, right? That we get caught in the crosshairs when the sell-off accentuates because of people who are unbinding their leverage trades. But before you hit the sell button on Nvidia or any of the Max 7 stocks, if you are indeed a long-term investor, then you really need to dig deeper into what really caused the sell-off and whether there is more than meets the eye. And if you really look at the DeepSeek saga, ladies and gentlemen, you will realize that is exactly the case. As in the sell-off and DeepSeek's announcements, both don't tell the full picture. So let me give you the full picture, at least my take. Yeah, obviously I'm no genius. This is not, the market doesn't run on the stock doctor's opinion or predictions. However, all I'm saying, this is just my opinion, take it or leave it, right? It's always that, right? Here's why. First, here's why the whole sell-off doesn't really give the full picture. Just the DeepSeek's announcement doesn't give the full picture. Firstly, while DeepSeek's innovations are amazing and I do find them to be impressive, and I seriously do, I'm not even being sarcastic. I tend to get sarcastic a lot when on a lot of matters. This is not one of those. I do find them to be impressive. It simply does not mean that demand for computing power is going to subside anytime soon. That is where my problem lies with the sell-off. On the other hand, it only continues to grow, actually. On the contrary, if you really think about it, demand for computing power is simply going to grow. In the week gone by, we had earnings from Microsoft and Meta. Both companies have said that their capex spend is going to continue. More specifically, Microsoft CFO Amy Hood, during the earnings call, reiterated that capex spend for third quarter and the fourth quarter would be on the same levels as that of Q2. Q2's capex spend, just to give you some further context, totaled $22.6 billion, up from $20 billion in the first quarter. Microsoft previously said that it plans to spend nearly $80 billion in capex in FY25, and the Q3 and Q4's capex spending projections show that it's on track to match or even exceed their target. So clearly, DeepSeek has not wrecked the capex spending plans of Microsoft. Meta even goes one step further, plans to spend $60 to $65 billion on capex in FY25, and there was absolutely nothing in the earnings call which suggests that the spending spree is going to stop there as well. And more recently, SoftBank, which announced the Project Stargate along with OpenAI and Oracle, actually is planning to lead a new venture funding round for OpenAI, something that would take OpenAI's valuation to a whopping $350 billion, in excess of $350 billion. More on that later, because the news is, more on that in another episode, because the news is still sort of, it's still not confirmed. These are rumors, but obviously it is looking to explore. And you pump all this money to build so much data centers and so on. Where is the demand going to go? It's going to go straight to Nvidia and the computing demand, right? So DeepSeek's innovation is not equal to reduced capex spend by the American AI giants. As such, the relentless selling spree in Nvidia and the Mag 7 simply does not make any sense. Nvidia continues to be in the driver's seat. As long as there is no drop in the capex spending, Nvidia is the one who is going to lead. I know there is opposition on the chips. By the way, I own Nvidia stock, so you can take it. Even this is not a bias though, but I got to say as it is. Disclaimer is out there. I didn't sell any of my positions. One of my biggest positions in my portfolio as well. So clearly putting it out there. So I haven't sold any of my shares because I simply don't believe this news to be what do you call it, the death knell for Nvidia. I don't know how else to put it. Now, that was the first reason I gave you. Second, there is skepticism about how DeepSeek achieved its breakthroughs. Some speculate that Chinese researchers may have stockpiled advanced NVIDIA chips before the US export restrictions or access them through third-party countries. Moreover, DeepSeek has also struggled with scaling its infrastructure to serve a global user base, highlighting ongoing challenges in deploying AI at scale. Not to mention, the 5.6 million number does not take into account the full cost. In other words, the 5.6 million figure that DeepSeek claims that it built its R1 model on simply doesn't tell you the full story. The sell-off in chip names like NVIDIA and Broadcom does seem like a case of shoot first, ask questions later, as one noted chip analyst described the bloodbath so eloquently. I mean, it truly is. It was just one news on performance of DeepSeek AI, and bingo bango, everybody's starting to sell off, right? It doesn't make any sense. Finally, there is also the allegation that DeepSeek might have used OpenAI's models to train R1 through a process called distillation, which actually involves extracting knowledge from a larger AI model to train a smaller, more efficient one. Now imagine that. So that if this were true, then we are in serious, then you know that the DeepSeek is just full of beep, right? OpenAI's terms of service actually bans this and has already banned accounts in the past which were suspected of distilling its models. And more importantly, OpenAI is actually exploring actively right now whether DeepSeek did the same. So if the allegation is true, then it could actually explain how DeepSeek achieved competitive performance with its R1 model despite using less advanced hardware. Lastly, even if DeepSeek achieved this breakthrough the way it said it did, then it could still benefit the likes of NVIDIA by increasing the overall demand for AI capabilities. Lower costs for deploying AI models might spur greater adoption, creating what we call a virtuous cycle of demand for training and inference hardware. NVIDIA, ladies and gentlemen, also remains critical for running large-scale AI applications, as even efficient models like R1 require significant computing power for deployment. And as we move from generative artificial intelligence, which is Gen AI, to artificial general intelligence, which is AGI, there is no way on planet Earth anyone can succeed without tremendous amounts of computing power. And I fully expected the likes of NVIDIA and Broadcom to be at the forefront of the transitions, the ones that got absolutely smacked. I don't think they deserve that at all. At least according to me. I get it. I do own Nvidia. I haven't sold my position, but here's why. Here's the thing. I'm giving you reasons why I didn't sell my positions. Why I continue to believe in the Nvidia story. Now, what you want to do with the information, that's completely up to you. Like I said, the Stock Doctor doesn't give investment recommendations. Bottom line, there is absolutely no question that the AI wars have entered a new phase with the arrival of DeepSeek's R1. It also showed how much irrational exuberance there was being pumped into the AI trade, and it also brought into light how little some of the investors knew about the Nvidia and Mag 7 as they prioritized the momentum of the AI trade rather than the fundamentals and the technical know-how. Moreover, the existence of leveraged products on NVIDIA and Mag 7 stocks further exacerbated the situation as panicked investors unwound the trade, which provided further fuel to the sell-off. However, when one really does a deep dive into the full story of the DeepSeek saga, then it becomes very clear that the reaction to the whole DeepSeek saga, to the whole saga, was clearly overblown. As such, the blatant sell-off could present a unique buying opportunity into names such as Nvidia and Broadcom. However, would I go all in on these names? Absolutely not. I don't listen. I don't go one extreme and then switch to the other. No, somewhere in the middle. Meet me somewhere in the middle. As such, momentum is a very powerful tool, and by the looks of it, currently there's momentum on the downside. You got to respect momentum. When you got to respect momentum, is whether it's upside or downside, and currently it's on the downside, for especially for the likes of Nvidia. As such, I would be very careful, if I were you, with my position sizing into these names. At the same time, my opinion, it gives long-term investors an opportunity to look into names beyond the Mag 7, especially in sectors that were left for the dead by the AI trade. The DeepSeek saga was a wonderful lesson on how dangerous investing based on irrational exuberance can be. It was also a reminder that the stock market is simply not a casino. Investors, both long and short term ones, would be smart not to forget this. On that note, let's head from the United States straight to India into our next segment, The Doctor Goes Home. Right, where do we start now? Doctor Goes Home. I did tell you last week that this segment this week would only have one theme, which is Budget 2025, the first budget under Modi 3.0. Now, if I was writing an article, ladies and gentlemen, this is not an article, I'm not writing, I'm telling you, I'm speaking to you, right? I'm speaking to you. But if I was writing about Budget 2025, then the title of that article would be, at least on the I give it some thought, by the way. Could be a crazy one, could be a bad one. I don't know. You let me know in the comments. But if I was writing an article, then the title would be Budget 2025 Catalyst for Consumption, and More Consumption. That's exactly what Finance Minister Nirmala Sitharaman had in mind when she delivered what was, to me, yet another power packed successful budget, one that was designed to turbocharge consumption. India Inc. might be a bit disappointed. I'll more on that later. But the Indian consumer would be absolutely thrilled. So before I go into the specifics and before I do a deep dive analysis on it, let me give you some key takeaways of the budget first. And probably the main takeaway and the big one from Budget 2025 was tax cuts for middle class, one that's expected to result in a surge in consumption as the common man finds more money in his bank account on account of lower taxes. More specifically, the budget introduced significant tax cuts to boost middle class consumption. Individuals earning up to 12.75 lakhs annually are now exempt from income tax due to an increased standard deduction of 75,000 rupees. A taxpayer earning 12 lakhs annually will save 80,000 rupees in taxes, effectively reducing their liability to zero. This move aims to increase disposable income and revive urban consumption, and I think it's amazing. It's a masterstroke from the FM. The good news is that these tax cuts did not come at the expense of fiscal prudence, and that's exactly yet another reason why I believe that the FM, our finance minister, has absolutely delivered a power-packed budget. On the contrary, FM Sitharaman found the perfect balance between managing the nation's fiscal deficit and the need to turbocharge consumer spending. Despite foregoing 1 lakh crore in direct tax revenue and 2,600 crores in indirect taxes on account of these tax cuts, the fiscal deficit target for FY26 has still been set at 4.4% of the GDP. Now, before you think that this is impossible or this is an insane target or there's some financial engineering going on, let me give you some more data to appease your fears and to actually tell you why the balance has been done perfectly. To offset the revenue lost as a result of the tax cuts, the government actually plans to rely on public companies' dividend public sector undertakings, PSUs, dividend collections. More specifically, the dividend collections from PSUs have been revised upward to 55,000 crores for FY25 with a target of 69,000 crores for FY26, which clearly signals the government's intent to leverage state-owned enterprises for revenue generation. So it's just simply, so it's not financial engineering. It's not mumbo jumbo that's coming out of my mouth. It's not mumbo jumbo that came out of FM Sitharaman's mouth. It's actually, there's a clear-cut plan on why tax cuts, why reviving consumption, why reviving the Indian consumers, spending habits has not come at the expense of fiscal prudence. Now, And also, just to let you know, this minor detail from the budget is a simplified tax code is expected to be unveiled soon, which again should make the lives of the consumer a whole lot better. Now, the obvious next question is why I said India Inc. may be a little disappointed with budget 2025 to an extent. Not much, but there's still reasons to be upset. The answer lies in the budget's lack of focus on capex spend. More specifically, the government increased its capex outlay only marginally from 11.1 lakh crores to 11.2 lakh crores, which fell short of expectations, and it actually signaled a shift away from the government's previously announced infrastructure driven growth strategy. Moreover, the upcoming Lok Sabha elections may delay spending execution. Railway and defense companies would also be extremely disappointed with Budget 2025, as there was barely any mention of these sectors. The railway saw absolutely no change in allocation for FY26. It currently stands at 2.55 lakh crores. And while the defense sector saw the budget allocation increase marginally to 6.81 lakh crores, it lacked any new schemes, which was a surprise given how much emphasis Modi 3.0 has placed on turning the nation into a defense export powerhouse. Even I was surprised that there was absolutely barely any mention. It also doesn't help that both these sectors underperformed in utilizing their allocated capex in FY25 due to delays in project awards, monitoring issues, and election related disruptions. Needless to say, stocks of both these sectors, which actually especially the defense stocks, have been on steroids as far as I'm concerned. I missed out an opportunity to invest. Maybe I look into it now, given the fact that both defense and railway stocks sunk immediately following the budget announcement, and they've been on a downward trend ever since. So maybe if you missed out on the defense rally, I still believe in the long-term long-term performance or long-term performance of defense sector and in long-term growth of the defense sector. My God, that's the word I was looking for. Long-term growth of the defense sector. Sometimes I just get lost for words. So I would definitely check into the defense names. If you missed out on the earlier rally, defense stocks on steroids, as I mentioned, you might get opportunities soon. So worth definitely exploring. Now, this is a show on investing, guys, which means a focus as investors needs to be on who stands to benefit from the budget announcements. Defense and railway stocks can be forgotten for now, although they should definitely now be back on your watch list and definitely should be monitored if you're a long term, if you want them to, if you're looking them for a long term play. Same can be said about infrastructure as well. This was very clearly evident when stocks of companies in these sectors, like I mentioned before, tumbled post the budget announcements. However, sectors like FMCG, auto, and consumer durables stand to gain massively from the consumer-focused budget. The boost to disposable income on account of tax cuts is expected to drive spending on daily essentials and is expected to revive urban demand, which has previously shown signs of fatigue. So companies like Hindustan Unilever, ITC, Dabur, Marico, and Nestle are expected to significantly benefit from budget 2025. Disclaimer here, I've been a long-term investor in ITC and Marico, have not sold my shares, so I'm just putting it out there. Higher disposable income is also expected to drive demand for entry-level automobiles, with the likes of Maruti, Tata Motors, and Hero MotoCorp expected to be the key beneficiaries. I'm not going to go into too much detail on this, given that I already gave you enough content in the last episode, and at the same time, the next week's episode, I will be tackling the auto sales as well. So there'll be too much auto information. So not going to go into too much details. All I will tell you is the standard disclaimer. I am an investor in Tata Motors. You guys already know this by now. But at the same time, I'm actually looking at Maruti Suzuki as well as my next investment. So don't be surprised if in the short term, I tell you, guys, I bought into Maruti, okay? Because stock has been doing, I'm looking for any weakness in the stock before getting into the name, especially now that the budget has become an additional tailwind for the stock. The other tailwind being the EBITDARA. The other key takeaway or reform from Budget 2025 was the decision to increase the FDI limit in the insurance sector from 74% to 100%. This should offer a massive boost for private insurers. So the likes of HDFC Life, ICICI Prudential Life, and Star Health stand to be major winners. And investors interested in the space should take a look at this. This is not a space that I cover much extensively, so I'm not going to speak too much about it. However, the increase in the FDI limit from 74 to 100 definitely should give some at least short-term boost to the private insurers. Bottom line, I would call Budget 2025 a massive success. To me, this is hardly surprising given the success rate of Finance Minister Nirmala Sitharaman. Having said that, I am a little disappointed. The budget was light on capex spending. I was definitely expecting a lot more money to be allocated towards the sector, given that economic growth was slowing, and despite significant government investments in infrastructure over the years, private investment continues to remain weak. So, in my opinion, the FM finance minister could have done better in that regard. Overall, though, this was a budget that belonged to the common man. It was one that was designed to turbocharge economic growth by putting more money in the Indian consumers' pockets. It reflected a political shift, rather, towards middle class benefits over aggressive infrastructure development. However, what is more important and what I absolutely love is that it did so by maintaining fiscal prudence, which I have to say is extremely commendable. I mean, kudos to that. Do I predict a mini budget focused towards driving infra spending in the coming months? Won't rule it out. However, I think the ball now is firmly in RBI's court to unveil measures that would further revive growth. It has already introduced, the RBI has already introduced measures to increase liquidity in banks. Initiating rate cuts simply has to be the next step, ladies and gentlemen. And as I mentioned in one of the earlier episodes, it's likely to happen sooner than later. All in all, if I were to conclude this segment, I would say the only thing I would leave you guys with is that the Indian growth story got a shot in the arm courtesy of Finance Minister Nirmala Sitharaman and her Budget 2025. Over to you, RBI. And on that note, let's head now to the final segment, Dr. Dissects, where I will be dissecting logistics giant FedEx, ticker symbol FDX, as it makes a return and goes under the microscope this week. I'm going to pause my camera for a second while I take the notebook, because clearly we'll be doing a valuation segment. Still talking, just taking my notes there. And I'm back. I got the notebook. Just wanted to make sure we get ready for when the valuation time comes in. Right. This week is all about FedEx, ticker symbol FDX. Now, the company announced its Q2 numbers towards the end of December, so it's been more than a month since the company announced its numbers. I'm not going to go too much into the quarter details. I'm going to talk to you about what am I looking at FedEx. But just to give you a little snapshot, Q2, the second quarter numbers were pretty, were really unimpressive. Okay, as usual. I don't know with this company. I don't know what is it with this company. For instance, Q2 revenues came in at $21.97 billion. It was down 0.9% year over year. Missed analyst estimates by 125.2 million. Non-GAAP diluted EPS was at $4.05. Up marginally, 1.5% year over year. At least it beat analyst estimates by 12 cents. Overall, it was not particularly great. You had operating income and operating margins also down marginally on a year over a basis. Operating income came in at $1.38 billion. It was down 2.8%. And the operating margins came in at 6.3%, which was down 10 basis points. Companies' cost-saving efforts simply were not enough to offset the sluggish industrial economy in the US. So that's sort of the quarter snapshot that I wanted to give you. But that's not really why I'm dissecting FedEx this week. I'm dissecting FedEx because there's been a major change structurally to the company's operations. Ever since the company announced its intention to undertake a strategic review of its freight business, I have been calling for a spin-off of the division. Go check it out. Go check out the previous episode that I tackled FedEx, and you will see time and time again I have mentioned how FedEx, if you are doing a strategic review, then a spin-off is the right decision. Thank God that FedEx management answered my prayers. And absolutely, I don't own FedEx, but I was definitely delighted for FedEx investors when the company announced that it was indeed spinning off the freight division, thereby leading to the creation of two independently publicly listed companies. Now, the spin-off is going to take a while. It's expected to take 18 months to complete. Although FedEx management during the earnings call mentioned multiple times that they would keep investors updated on the progress of the transaction, I still think it would take 18 months. I'm not a believer of FedEx management. Yeah, I'm just going to put it out there. I also like the company's announcement that Claude Ross, former CFO of FedEx Frieght, would lead the spin-off efforts, as it ensures that the process would be done with a sense of continuity, which leads to me, that's probably, if you were to give me a reason why I should believe that could get done ahead of schedule, one such reason could be the announcement that Claude Ross is, there's a sense of continuity with the appointment of Claude Ross. Now, the question that FedEx investors need to start asking is whether to maintain their shareholdings in both companies, or if they need to make a choice. If I was an investor, I would be opting to be the shareholder of the freight entity rather than the parent company. This is because Freight, despite currently being the largest carrier by revenue and despite having the broadest network and the fastest transit times, lags significantly relative to its competitors. According to data from Bloomberg Intelligence, Freight currently has an enterprise value of more than $30 billion. More importantly, according to data from CNBC, the freight peers such as XPO and Old Dominion currently trade at a forward price to earnings of 38 and 36 times, respectively. FedEx Freight, on the other hand, has a forward price to earnings multiple of just 14, 1-4. Competitors are trading at 38 and 36. The freight currently trades at 14. So the significant valuation gap is expected to reduce following the spin-off, which does suggest that the freight business should have considerable upside from current levels. Moreover, despite the challenges faced by the division due to a challenging macro environment, the division has actually been a market leader for a long time and has actually managed to increase operating profit by 25% per year on average over the last 5 years, which translates to an operating margin expansion of approximately 1,100 basis points, or a whopping 11%. And as I mentioned last time I talked about FedEx, the growth in operating margin of Freight has significantly outperformed its other divisions of FedEx, Express, and Ground. The company, during the earnings call, also announced several initiatives to beef up the freight division ahead of the spin-off, which were positive in nature, in my opinion. For instance, the company plans to build a dedicated LTL sales force with more than 300 large truckload specialists expected to join this team by the end of the transaction. Other initiatives include an enhanced LTL specific pricing and invoicing system, improved FedEx and Freight network efficiencies, and incorporating more automation, all of which, in my opinion, should help the company to drive growth and help it to continue to capture market share post the spin-off in a market which is expected to reach $125.8 billion by 2029. Finally, guys, I also do academic research. You should already know that by now. May have left Brunel, but I'm still affiliated to the place as an honorary associate professor. So I do continue to do my research. And so, of course, I got to talk about some academic studies here. Academic studies have actually shown that spin-offs undertaken with an eye to improving corporate focus do experience superior long-term returns as well as superior improvements in operating performance. Given that Freight spin-off is undertaken with the goal of improving corporate focus, and this is not an air quote out of sarcasm, that's what the term is called, corporate focus, holding the shares of the spun-off entity is expected to be rewarding for the long term. Overall, FedEx investors, in my opinion, have every right to cheer the company's decision to spin off the freight business. Hallelujah. It's the right decision, in my opinion, one that can unlock significant shareholder value in the long term. However, post the spin-off, investors are simply better off holding on to the freight entity rather than the parent company, as it has the potential to deliver higher returns in the long term. And with that, ladies and gentlemen, notebook out, pens out, let's talk about valuation. Now, FedEx management once again revised its FY25 EPS guidance on the downside. Surprise, surprise. With full year non-GAAP EPS. So full year non-GAAP EPS, let me just put this is for FedEx. Full year non-GAAP EPS is now expected to come in between $19 and $20. Prior guidance was 20 and 21. They've been revising downward for a while now. This is precisely why with FedEx management, I would never trust them completely. Okay, I'm really starting to believe right now, guys, that FedEx management is overestimating its ability to execute. Given that this is the second consecutive EPS revision to the downside, why bother giving a guidance if you don't even anyway? not going to go into a rant now. As such, so I'm going to revise my FY25 EPS guidance. That's the more important point. My projected FY25 EPS guidance is 19, right, which is the lower end of the company's guidance. This goes to okay. My previous estimate was 20. Now it's 19. According to LSEG data, formerly Refinitiv, the company currently trades at a forward price to earnings of 13.4. It was trading at 12.9 during the time I previously talked about FedEx. It continues to trade cheaper than its peers such as UPS, which trades at 14.5, XPO 30.3, and Old Dominion 30.9. The current multiple continues to be in line with its 5-year historical median multiple of 12.7 and its 12-year historical median multiple of 13.4. Now, the spin-off of Freight is a fantastic move, and as mentioned earlier, I prefer the Freight division over the rest of FedEx, given that it appears to be significantly undervalued compared to its peers. However, there is a catch. The catch is that the spin-off is not due to be completed for another 18 months, and the outlook on the company for the next 12 months has simply not changed since the last time I spoke about the company. The icing on the cake is the repeated downward revision of earnings of FedEx management. So if I'm taking all things together, I simply have assumed a projected PE of 12.7, which is the company's 5-year historical median multiple. Okay, I just don't. There's too much headwinds there, and there's too much management incompetence to an extent there as well. Now, the company, according to Seeking Alpha, currently trades at a forward price to earnings to growth ratio of 1.09, similar to its 5-year average of 1.14. Now, if I were to assume forward peg ratio of 1.09 and a forward price to earnings multiple of 12.7, I would get a earnings growth rate of 11.65%. Now, if I were to, at that, the company would have generated year-over-year EPS growth of 10.3. If I were to go at 1.14, if I assume 1.14, then the earnings growth would be 10.3%. So if I were to go, let me put this 1.09, the growth would be 11.65. If I do 1.14, it becomes 10.3%. Okay, so 11, that's the peg ratios. Yeah, the forward PE remains the same at 12.7. Now, do I believe that the company can generate 11.65% year-over-year growth in FY26? Would be a reasonable estimate, assuming the drive program goes according to the plan. On the other hand, if one takes the sector median forward PE peg ratio of 1.9 and apply it to FedEx, then earnings growth would be 6.68. So if I were to take 1.9, which is the industry median, okay, which is the industry median, then the earnings growth would be 6.68%. Okay, 1.9, if I were to, that's the industry median, then the earnings growth would be 6.68%. This to me is a more reasonable estimate given the macro challenges and given my rationale that the management is simply overplaying its ability to execute. At this growth rate, so I've assumed a growth rate of 6.68%, and then FY26 EPS projected would come in at 20.27. Okay, FY26 EPS would come in at 20.27. A forward price to earnings of 12.7, multiply that with 20.27, and you get a price target of about $258, which is around the levels at which the stock is currently trading at. 258 is my price target. The updated price target, my previous price target was 250, bumping it up 258, but because the stock is currently trading at these levels, the rating is a hold. Okay, so there's little to no upside at current levels, so the rating is a hold. Bottom line, it was a subpar quarter from FedEx, guys. While revenues beat analyst estimates, EPS once again missed expectations. The only solace was that, like I mentioned multiple times in this segment, FedEx management can finally answered my prayers, announced I was indeed spinning off the freight business. The transaction is expected to take 18 months to complete and should unlock significant shareholder value, in my opinion. Given the significant valuation discount for the freight business relative to its peers, as well as a potential new management at the helm for the division, I do believe that FedEx investors are better off ditching the parent company and solely holding the shares of the spun-off entity for the long term post the transaction. In the meantime, as we wait for the spin-off to be completed, the immediate cause for concern is that although the company's Drive program made significant progress in the quarter, the impact of the program remains highly inconsistent. Furthermore, given that management has once again revised its FY25 guidance to the downside, there are serious question marks surrounding the ability of the management to execute. As long as this remains the case, the Drive program and its impact also can't be fully trusted. More reasons for investors to switch to freight in 18 months. That's all the time I have for you this week. I know I haven't discussed the Fed like I said before, but I will do so on the next episode. For now, if you have a specific Indian or US stock suggestion for the stock doctor to dissect and diagnose, do tweet me at Uttamvinay UTHAMVINAY or email me on the stock doctor podcast at gmail.com. Thank you once again for listening. I will see you next week. Actually, I will see you in 5 days. Until then, stay safe and make some money.